Success in trend trading is not found in complex algorithms or arcane indicators, but in the unwavering adherence to 5 fundamental timeless rules of discipline. These principles, derived from the hard-won experience of market masters like Jesse Livermore, provide a clear, actionable framework for navigating the inherent volatility of financial markets. The goal is to establish a system that removes guesswork and emotion, focusing instead on observable price action and confirmation signals. We are not attempting to predict the future. We are studying human nature and reacting only when the market confirms the path of least resistance. Before we delve into these foundational rules, please take a moment to subscribe to the channel and leave a quick comment below. Even just a single word or an emoji helps the algorithm tremendously, ensuring this vital content reaches more traders seeking serious guidance. This simple action shows me that this kind of practical, disciplined instruction truly matters and is worth creating for the community. Furthermore, remember to return to this channel during challenging times, especially when trading becomes difficult and your confidence starts to waver. The successful trend follower acknowledges that the market is a study of forces, where large institutions and widespread fear drive prices far beyond logical calculations. These 5 rules are the operational blueprint for identifying, entering, and managing long-term trend positions with the necessary psychological detachment. They represent the distilled wisdom of decades, emphasizing confirmation and patience over rampant speculation. By mastering these rules, the trader stops fighting the market and begins to ride its powerful natural movements. The core thesis of profitable trend trading is surprisingly simple. Success relies not on genius, but on rigorous self-control and the mechanical execution of a proven methodology. Historical market giants recognize that indicators merely lag price, and true edge lies in understanding the context of the move. These 5 rules serve as the unbreakable commandments for managing capital and exploiting the large, sustained moves that generate the majority of trading profits. They provide the necessary structure to filter out noise and focus solely on the direction of overwhelming financial force. We must establish a clear, actionable framework for identifying, entering, and managing positions that exploit these powerful long-term trends. This framework allows the trader to remain consistently objective, preventing emotional decisions from destroying well-laid plans. The method focuses entirely on observation and confirmation, treating speculation as a study of human nature expressed through price action, not as a mystical art of prediction. Discipline is the true currency of the market, and these rules are its foundation. Rule 1 demands that the trader determines the primary direction of the market before any other action is taken. This is defined as the line of least resistance, the path the market will continue moving along until a significant confirming force changes its trajectory. If the major trend is up, every trade must be a long trade. If the major trend is down, every trade must be a short trade. Ignoring this fundamental rule invites unnecessary risk and guarantees a lower probability of success. The practical application of this rule necessitates looking at the major charts, typically the daily or weekly time frames, to define the dominant force. Attempting to trade against this dominant force, known as counter-trend trading, is strictly forbidden under this disciplined approach. History shows that approximately 80% of all trading losses occur when the trader attempts to fight the primary direction of the market. The market is never standing still. It is always moving toward the path of least resistance, and the successful trader must move with it. Identifying this direction is not complex. It requires observing the sequence of swing highs and swing lows. A clear uptrend is marked by consistently higher highs and higher lows, while a downtrend shows the opposite pattern. The trader must align their entire strategy with this overarching structure, recognizing that short-term fluctuations are merely noise within the larger movement. To trade successfully, one must be patient enough to wait for the major trend to assert itself clearly before committing capital. Counter-trend trades are inherently speculative gambles, whereas trading with the trend is a statistical observation of momentum. The discipline required here is absolute patience, waiting for the market to confirm its intentions on the higher time frames. Many novice traders make the mistake of focusing too heavily on the hourly or 5-minute charts, losing sight of the massive forces driving the weekly price action. By defining the major trend first, the trader ensures that their positioning is aligned with the institutions and funds that provide the necessary capital flow for sustained movements. This alignment provides a statistical advantage that no amount of indicator juggling can replicate. Rule 2 emphasizes the necessity of waiting for the pivotal point, which is the specific price level or moment of confirmation that proves the trend is truly underway. This point confirms the shift from consolidation or false movement into genuine directional momentum. Never should a trader enter a position based on prediction, hope, or a feeling that the market should move in a certain direction. Entry must only occur after the market has broken out of a critical congestion area with demonstrable force. The pivotal point acts as the definitive signal that the trade is moving out of the dangerous zone of indecision and into a high probability expansion phase. This breakout must be accompanied by confirming volume, indicating that committed capital is driving the move, rather than a temporary fluctuation. Identifying the precise price point where momentum shifts is crucial for achieving an optimal entry and minimizing immediate risk exposure. Entering prematurely often results in being stopped out during the final stages of a consolidation pattern. Patience is the core instruction embedded within this rule. The trade that starts right often finishes right, meaning the entry must be clean and confirmed. Waiting for the breakout above the previous resistance in an uptrend or below the previous support in a downtrend provides immediate validation for the position. This confirmation allows the trader to minimize the risk inherent in the initial commitment of capital. A decisive breakout confirms that the line of least resistance defined in Rule 1 is now actively being pursued by the market. This methodology relies heavily on recognizing accumulation and distribution phases that precede major moves. Understanding these cyclical patterns is essential for locating the true pivotal point, where significant capital is finally released into the market. For those seeking a deeper structural understanding of how these congestion zones form and break, a dedicated study of historical market cycles is invaluable. If you are looking to master the underlying structure of market movements, especially the critical shifts from quiet accumulation to explosive trends, we highly recommend exploring the Richard Wyckoff Trading Methods channel. This resource is dedicated to the deep study of Richard Wyckoff's methodology, including detailed analysis of accumulation and distribution cycles, and how to anticipate major shifts. Wyckoff's approach offers a powerful lens through which to view price action, complementing the trend-following principles we are discussing today by providing context for the pivotal points. Mastering these concepts will significantly enhance your ability to identify high-probability breakouts and understand the forces acting behind them. Take your trend analysis to the next level by accessing the complete Wyckoff methodology through the link provided in the description. Rule 3 dictates the capital management strategy known as pyramiding, which involves scaling into a position only when the initial commitment is already showing a clear profit. This is perhaps the most powerful rule for maximizing gains during strong trends while strictly controlling overall risk exposure. Pyramiding is the antithesis of the fatal mistake made by most amateur traders, averaging down a losing position. Never, under any circumstance, should a trader add capital to a trade that is moving against them. Capital is added incrementally, perhaps in units of 20% of the intended full position size, only as the market confirms the trader's initial judgment. If the first unit shows profit, the trend is confirmed, and the trader can add a second unit, raising the overall exposure. The calculation of these scaling points is crucial, ensuring that each subsequent unit is purchased at a higher price in an uptrend or a lower price in a downtrend than the previous unit. This structure ensures that the average price of the entire position remains favorable relative to the current market price. Pyramiding maximizes gains in strong trends because the largest capital allocation is deployed only when the market has already proven the analysis correct. The risk exposure remains limited to the initial, small unit until the market itself provides the capital, the paper profit, to justify further commitment. This system ensures that the market pays for the majority of the risk taken, allowing the trader to capitalize fully on the sustained movements that define successful trend trading. It is a conservative yet aggressive approach to capital deployment. The mechanical process requires discipline. If the trade stalls or reverses after the first unit, the trader liquidates the small loss or small profit and moves on. If the trend is strong, the trader continues to add units at calculated intervals, maximizing the leverage provided by the market's momentum. This method prevents the devastating losses associated with doubling down on mistakes and instead focuses capital only on confirmed winners. Pyramiding transforms a good entry into a massive profit generator by aligning capital deployment with confirmed market strength. Rule 4 states the absolute requirement of protecting capital by establishing the maximum acceptable loss before initiating the trade. The preservation of capital is the paramount duty of the trader, and no position should ever be entered without a predefined immediate exit point. If the market moves against the initial position by a predetermined amount, whether a specific percentage, a dollar amount, or the breach of the pivotal point, the position must be liquidated instantly without hesitation. The stop-loss must be treated as sacred and absolutely unmovable, serving as the ultimate defense against catastrophic loss. A common failure among traders is allowing a small, manageable loss to turn into a large, portfolio-threatening disaster by moving the stop-loss further away. The disciplined trader understands that they must sell quickly when they are wrong and accept the small loss as a necessary business expense. This rule ensures that the maximum risk is known and accepted before the trade even begins. Defining risk allows the trader to remain objective and emotionally detached from the outcome of any single trade, understanding that losses are inherent to the probability game. The stop-loss should be placed logically, often just below the pivotal point of entry or below a recent swing low in an uptrend, signifying a true failure of the setup. If the market hits the stop, the premise of the trade has been invalidated, and there is no room for hope or rationalization. The commitment to this rule separates professional risk managers from hopeful gamblers. The stop-loss is the foundation of capital management, ensuring that the trader survives long enough to capture the few large, profitable moves that define success. By strictly adhering to the stop-loss, the trader ensures that no single error can wipe out months of profitable work. This mechanical approach removes the fear that often paralyzes traders, allowing them to execute trades with confidence knowing their downside is strictly capped. Rule 4 is non-negotiable for long-term survival in the markets. Rule 5 is often the most difficult rule to master, demanding the mental fortitude to remain in a profitable trend position until concrete market action signals a reversal or maturity. The primary mistake of profitable traders is taking small profits too early, thus negating the entire purpose of trend following. Trends provide the largest profits, and attempting to time the exact top or bottom is an impossible and ultimately unnecessary task. The focus must be on capturing the vast middle portion of the move. The trader must avoid the temptation to liquidate a position simply because the paper profit looks attractive or because minor fluctuations cause anxiety. Minor pullbacks and consolidations are natural features of a healthy trend and should not be confused with a genuine reversal signal. The only thing that matters is the market's action. Is it still making higher highs and higher lows, or has that structure been definitively broken? Premature liquidation sacrifices the exponential gains that strong trends offer. Holding the position requires ignoring daily noise and focusing only on the clear reversal signals established before the trade began. These signals include a failure to make a new high, a high-volume selling climax, or the decisive breach of a major support level, such as a long-term moving average or a previous pivotal point. Until one of these concrete signals appears, the trade remains open, allowing the maximum potential of the trend to be realized. The market will tell you when the trade is over. The trader does not need to guess. This rule emphasizes the core principle articulated by market giants. It was never my thinking that made the big money. It was always my sitting. This realization underscores the fact that time and patience are far more valuable than constant activity or attempting perfect timing. The true profit comes from allowing the market to run its course, trusting the initial analysis and the disciplined adherence to the stop-loss and pyramiding rules. The power of sitting tight transforms small profits into generational wealth. These 5 rules, determining the line of least resistance, waiting for the pivotal point, trading only in units of success, defining the stop-loss before entry, and the power of sitting tight, form a complete disciplined system. They cover the entire life cycle of a successful trend trade, from initial identification to controlled entry, responsible capital management, and patient exit strategy. The system is designed to maximize exposure to the few large moves the market offers while strictly limiting losses on the inevitable majority of trades that fail. Successful trend trading is built entirely on observation, confirmation, and the strict adherence to these mechanical rules. By removing personal opinion and relying solely on price action confirmation, the trader aligns themselves with the most powerful forces in the financial world. The goal is not perfection in every trade, but consistent profitability achieved by letting winners run and cutting losers short immediately. This disciplined approach ensures that the trader remains objective, focused, and solvent for the long term. The ultimate takeaway is that profitability in the markets comes from discipline, not genius, and the emotional detachment provided by a rigid set of rules is the ultimate edge. These principles are not theoretical. They are the battle-tested lessons learned through decades of speculation and market cycles. Mastering these 5 rules means transforming from a reactive gambler into a proactive, successful student of market momentum. The historical lessons embedded in these rules are timeless because human nature, the ultimate driver of market trends, never changes. For those who wish to delve deeper into the psychological and strategic foundation of these trend-following tactics, particularly the mindset required for disciplined execution, there is an invaluable resource. The experiences of the great market operator, whose principles underpin this entire framework, offer profound insights into the required mental toughness. We highly recommend the new edition of Reminiscences of a Stock Operator by Edwin Lefebvre. This classic offers a deep analysis of the psychology and strategies of Jesse Livermore, the trader who mastered these exact 5 rules. This edition is enhanced with unique practical commentary and chapter-by-chapter breakdowns, transforming his historical experience into actionable, practical lessons for modern traders. It is the essential companion for developing the necessary mental discipline to execute these rules flawlessly. You can gain access to these profound psychological and strategic insights by finding the link to the book in the description below. Thank you for watching and committing to the disciplined path of trend trading. Remember, the market rewards patience and punishes impatience. Stay disciplined, trust the rules, and let the market prove you right.